Good morning. Welcome to IG's early morning call. It's Thursday, 19th of October. Let's take a look at the headlines as we're monitoring what's going on in the foreign exchange markets. So get an update on what's happening in terms of US Fed expectations with Jerome Powell expected to speak later on today. Reuters poll, meanwhile, says that whilst rate rises may be over, rates will stay higher for longer than thought before the next step on the way down. In amongst some of the stock news, late last night, Tesla shares took a bit of a dent. Elon Musk is concerned about the impact of high interest rates. He's been cutting prices at Tesla, and it's eating into margins. The stock was down fairly heavily last night. That being said, it wasn't quite so bad. When all was said and done, late last night, we saw a 10% rise in Netflix shares, the streaming giant, posting a far better than expected number in terms of new subscribers, and it's raising prices. Let's take a look at volatility. The occupation of the minds of traders still very much what's happening in Gaza, and that's where all the news is coming from. Really not necessarily just on the front page of the broadsheets, but also in amongst the business pages as well. And obviously concerns about the human tragedy. Markets are on the way down broadly, and we see money going into volatility. 19.68 is where we're standing there at the moment. We are expecting a drop at the start of today's trade across the European markets. There was a fairly hefty drop in the session in yesterday's trade. This is the FTSE 100, and we're now climbing, falling further on down. And 75.48 is where we're trading there at the moment, despite the fact we've got oil pretty much holding on to the gains that we've seen recently, which has been boosting the London markets. We've now got a drop there. This is the long-term chart. It's very difficult to work out precisely where this is going, but I would fire a warning shot across the bows of what's happening on the European continent. As we'll see in just a minute, the French CAC 40 is in a far more advanced stage than the German DAX. I think we're going to get a break of this line of support at 14,943. I say I think. It certainly seems like the directional travel at the moment is such. The 24-hour markets yesterday closing at levels not seen since the 27th of March. Not quite as low as we were intraday back on the 4th of October, where we hit that line of support, which I've drawn here at 14,943. We're 17 points over the 15,000 level at the moment, but it certainly seems like this inexorable drop on the German DAX is going to continue. And if you get a break of that and a candle close below the 14,943, we then on the way down to 14,458, which was the intraday low we had back on the 20th of March this year. So I think this rolling over pattern is now beginning to bear fruit for those that have been short. Continue the short trade. If you are just entering this market, stock goes above yesterday's high point in the market, so around about the 15,300 level. 15,020 is where we are at the moment, 14,458. Talking about the French markets, just wanted to highlight what's going on in France. We've seen some numbers out today from Renault. I should actually say we're expecting a drop for SAP on the German DAX as well today because of third quarter numbers out late last night. Renault, same sort of thing, potentially could be a downside trade on the French CAC 40 this morning. Yesterday, the 24-hour markets closing below this line of support at 69.46, taking us then to a close not seen since the middle of March. And indeed, we're building on that position at the moment. Short trade winning out. And the next price target on my chart here is 67.77. Stock goes above this previous line of support, now resistance. So you'll stop at around about the 7,000 level, 69.12, 67.77, the price target for the French CAC 40 that's rolling over here. As I say, like the German DAX, beginning to bear fruit on those that are short. Let's take a look at what's been happening in the Asia-Pacific markets as we see trade, broadly speaking, losing ground. As we'll see in a minute, it was a day of pressure yesterday for Wall Street. The European markets, as I said, just looking as though we're going to open on the way down, and it's been a drop across the board on the Asia-Pacific markets. Hang Seng stock index, when last look, was down 2.1%. We saw a market close today on the Nikkei at 1.8%, 1.3% down on the S&P ASX 200. Let's take a look at what's happening in the Wall Street trade yesterday, ending the session on Wall Street with losses for the Dow, losses for the S&P 500, more losses, I should say, for the NASDAQ. And we've got these markets building, or rather holding on to these losses. If you look at what's happening on the NASDAQ, everyone's talking about that rolling over on the European markets. These lower highs continue. And if you are short on this at 14,890, this is your price target down here at 14,440. This is the NASDAQ Tech 100. And it's the same sort of thing, I think, coming into the markets in today's session on the S&P 500. Price target now 4,200 for the S&P 500. 4308 is where we're trading at the moment. There is a green candle on the 24-hour markets at the moment, but we'll have to see how things develop in terms of some of the market moves today. Ahead of the open, we've got some more companies reporting earnings a little bit later on today on the US markets. Now, the Fed chief, Jerome Powell, and several Fed officials are due to speak today in New York. The last FOMC meeting concluded with the decision to leave interest rates unchanged at a range between 5.25% and 5.5% to assess how the economy was evolving. So it's a question of measuring what's coming through in terms of economic data. Well, since then, it's shown US job growth reaccelerating unexpectedly, in other words, more heat in the economy, and retail sales defying prediction of a slowdown, questioning the impact the Fed tightening campaign has had on inflation. Let's take a look at a Reuters poll we've seen out overnight. More than 100 economists published showing more than 80% expect no rate hike at the next meeting, and most also believe the Fed is done with raising interest rates in the United States of America. However, the Fed may wait longer than previously thought, according to the survey, before cutting rates. Around 45% of them now see no rate reduction until the second half of next year or later. That is up from 29% in the last poll conducted by Reuters. Let's take a look at the dollar basket. In the wake of this, we've got a rise late yesterday, and we're continuing into today's session of the 24-hour markets up at 106.27. So on the fears that interest rates could remain longer than expected, it's a question of buying the dollar once again on the markets. Meanwhile, all this coming as we see Japan unexpectedly return to surplus in terms of trade numbers. 62.44 billion surplus compared to a deficit of 2 billion yen in September last year, and economists' expectations of a deficit of 425 billion. It was the first trade surplus in 3 months in the Japanese economy, as exports rose by 4.3% year on year. Excuse me, this is growing for the first time since June. Among these, car exports rising 30.4% year on year. You can see why the weak Japanese yen has done so much good in terms of the Japanese Nikkei over the last few months. Meanwhile, imports to Japan shrank for a sixth straight month by 16.3%, worse than the market forecast of a 12.9% move. Let's take a look at what's happening on the Japanese yen. It continues, the US dollar continues to bump up against this red dotted line here, the 150 yen level. Apart from that day when we saw it rise above on the 3rd of October, it really hasn't managed to escape the bounds of that 150. But if we do see a trade beyond that, you're then long up to 151.95, watching the dollar against the Japanese yen. Euro dollar, we got weekly jobless claims out today. Not really a market moving number, I don't think, in the context of everything else. Second day in a row of losses, down to 105.35 for euro dollar. Now, a whole ton of companies reporting earnings. We are right in the thick of the earnings season. I want to begin, first of all, with one retail stock that's quite often hitting the headlines. Third quarter gross numbers at Deliveroo. Transactional value up 5% year on year. Seems like a good number, actually. Full year 2023 guidance maintained. Adjusted EBITDA expected to be in the range of 60 to 80 million pounds. This company could well be a mover at the start of today's session. I want to show you the share price chart because we've seen this rise from the beginning. When was that? 28th of March this year. I've got that on there for some reason. I don't know why. Let's take it back to October last year, where we've seen 82% rise in Deliveroo shares. Since then, there's been a little bit of consolidation. We'll open at 123.2 if you're long on this. Stop goes below the 120 level for Deliveroo. Meanwhile, Dunelm sales up 9%. Digital sales made up 35% of the total. That would seem to indicate that it's online that Dunelm's doing brisk business, but the company says it's on track with its accelerated store rollout plan of 5 to 10 stores per year for the next 2 years, with 1 new store opened in the first quarter and a further 3 expected to open before the end of the second quarter of this year. So that is a positive retail story here in the UK. The stock, well, it fell yesterday by a margin of 0.5% at 10.43. Be interested to see where this stock gets underway a little bit later on. Let's take a look at another stock I want to take a look at today. London Stock Exchange has been trading between the 79.86 and the 86.14 traded range that we've seen since it went into that back in April this year. Total income up 8%, on track to deliver full year growth towards the upper end of the 6 to 8% guidance range. So I think this is possibly a good, a stock story, possible stock story today on the way up. If so, stop goes below the 200-day moving average at £8 a share. 80.91 It's where this stock will open a potential upside. All 2023 guidance reiterated, EBITDA margin and capex all expected as it was previously, but it says it will be towards the top end of the range. The £750 million directed buyback completed in the third quarter, £1.5 billion, according to this statement this morning, returned to shareholders since August 2022. Let's take a look at what's happening on the German markets. We've got the German software house SAP reporting third quarter numbers after the bell last night, and it wasn't particularly good either. Operating profit was up 11%, total revenue up 4%, but third quarter non-IFRS cloud revenue, which is one of the big measurements that SAP uses, was at 3.47 billion. We had been looking for something closer to 3.6 billion euros for this number. So that, if you use that as the benchmark, could well indicate a possible downside to the stock when trade gets underway later on. As of the recent lows on 2026, the stock will open at 121.44. If you get a break of that, the next line of support is the 119.24 rising red line here, which is a 200-day moving average. Staying on the charts, just wanted to move on to what's happening with Nokia. Don't hear an awful lot about Nokia anymore. The telecoms equipment infrastructure company, the networking gear company. Looking as though we could well see another drop at the start of today's session. We've seen some numbers coming through, and they're pretty awful, if I'm totally honest with you, for the third quarter. But for me, the headline is the fact the company's going to cut costs. 14,000 jobs. I think the company runs around about 70,000 jobs, I think, in total globally. 14,000 positions are going to go as part of a new cost savings plan after third quarter sales fell 20%. Nokia is targeting between 800 million and 1.2 billion euros in cost savings by 2026. Cost savings normally see an upside surprise on the markets in reaction, but I think in the context of the third quarter figures, which look pretty dire, I'm wondering whether we're going to get a break of this 321 line of support we had established there back in March 2021. The stock will open at 326.3. Just wanted to highlight that for you as another stock story to watch, as indeed is Nestle. Very similar in terms of the overall feel for this share price chart direction. 102.14 is where we got open in Nestle this morning. The group posted lower than expected 9-month sales growth as higher product prices continues to dent volumes. Nestle 9-month sales, 68.83 billion. We've been looking for something closer to 69.6 billion Swiss francs, that is. So I think potentially, again, this is a downside story. 102.14, line of support 98.36. If you go short on this, stop goes above recent price action. Your stop loss, that is, with a price target of 98.36. My figures muddled up this morning, but that's the direction of travel. These lower highs continuing to see Nestle continue to move on down to that line of support at 98.36. In France, meanwhile, I want to quickly catch up on this automaker here. I was saying in France we're expecting a drop at the start today. One stock that could well buck that is Renault. Revenues rising by 7.6% in the third quarter, 10.5 billion euros. Sales growth this year coming after 4 years of consecutive declines for the French group. The stock will open at 36.03. Support is at 34.54. The resistance is at 39.48, the band in which we are looking there at the moment. Tesla shares dropped more than 8% in extended trade on the IG platform late last night. You could trade those shares after close. It reported the earnings are coming in at 66 cents per share. We've been looking for 73 cents and down from 105 in the same quarter last year. Revenue up 9% to 23.35 billion from 21.45 last year. However, below estimates of 24.1 billion, which was expected by analysts and marks the slowest pace of growth in more than 3 years for the electric vehicle maker. This is an interesting story to continue to follow, where we've seen stiff competition coming through from Chinese automakers. Tesla's gross margin dropped 17.9% because Elon Musk has been cutting prices to compete with the Chinese exports. Tesla's gross margin dropped to 17.9% in the quarter, compared with 25.1% a year earlier, when it had just about started cutting prices. Let's take a look at the share price chart for Tesla. Before I do that, the quote from Elon Musk in his conference call last night expressed concerns about the impact of high interest rates on car buyers. He also said that he was hesitating on the group's plans for a factory in Mexico as it gauges the economic outlook. He says if the macroeconomic conditions are stormy, even the best ship is still going to have tough times. That's a clear change of tone. Last year, Musk was saying Tesla was recession resilient. Let's take a look at the share price move last night. You can quite clearly see the drop that we saw ending down at levels not seen since the 25th of August. This is certainly a stock story to continue to watch today when we cover this in Beat the Street at 1:30 p.m. UK time. It was a great night out last night for Netflix in the markets. The streaming giant reported a bonanza third quarter subscription number, earnings per share as well, topping estimates $3.73. We've been looking for $3.49. Revenues $8.5 billion. We've been looking for something like around about that sort of figure. But it added 8.76 million new subscribers in the third quarter, far exceeding forecasts and boosting its overall subscriber base to 247.2 million. The company credited a strong programming slate and its crackdown on password sharing. Total memberships expected 247.15 million against 243 million that we have been looking for. So, in fact, it's better than the markets had been looking for. And all this was reflected in the share price move at the end of yesterday's session, a big upside surprise coming through, with the stock ending at levels pretty much not seen since the 20th of September. These big declines coming through on concerns that people have been possibly cutting their subscriptions because of the consumer pressures being brought about by higher interest rates, but none of it. Netflix adding and also saying it's going to be raising prices, which gives the potential for further increases in share prices over the next few quarters or so. Alcoa shares fell in extended trade last night on the IG platform after reporting a quarterly adjusted loss of $1.14 per share. The mean expectation of 9 analysts for the quarter was for a loss of 1.02 per share. Revenue fell 8.7% to 2.6 billion from this time last year, but that was pretty much in line with forecasts. Alcoa responding, of course, as well to some of the pressures in the aluminium market. You can see here in the session recently, we've seen shares drop down to levels, 25.60, not seen since the 6th of April. Shares in extended trade last night fell 4.66%. Let's take a look at some of the stocks to watch today, which we'll be covering in Beat the Street. American Airlines third quarter estimates of 32 cents on revenues of 13.35 billion. Certainly one of the companies that will be in focus today. Also before the bell, AT&T, the street anticipating earnings of 62 cents per share on revenues of $30.2 billion. Another stock worth watching, and another stock trades in extended trade on the IG platform. So we can get a trade on that when it reports numbers before the bell. Another one to watch out for is Philip Morris. This is the company that's been in the tobacco sector, but moving into some of the more modern forms of inhalation. Earnings expected at $1.61 and revenues of $9.2 billion. Now, let's take a look at what's been happening in other markets. The oil market particularly. Yesterday, EIA crude oil stocks matching the API estimates published on Tuesday, with inventories falling by 4.5 million barrels. Refined product stocks also falling. Gasoline by a margin of 2.37 million. Distillates down by 3.18 million. Now, Mark Oswald, he's the chief economist and global strategist at ADM Investor Services International. He gave us his thoughts yesterday on the risks around the oil markets, given the recent turmoil in Gaza.
Yes, I think that things in the Middle East are more likely. The risk is that they're going to get worse before they get better. There seems to be little ability on either side to bridge the gaps, and there isn't any real ability of any of the other geopolitical forces to also bridge that gap. So it leaves us in a situation where the risks for oil and for gas markets are all stacked very much to the upside. And even if demand is generally weak and production, there's a lot of spare production capacity, the risk is going to underpin hydrocarbon prices, I can see, certainly well through Q4.
Mark Oswald talking yesterday to IGTV about the potential upside for the oil markets. We're trading at 90.30 on the IG platform for Brent crude. Price target 95.33 was the highs that we saw back on the 28th of September. That would be your price target if you are long on this. If you're long, stock goes underneath the $90, $89 level would be a good place to go if you're long on crude, given what Mark was just saying about the potential outlook and concerns about geopolitics pushing the price up. Geopolitics really absorbing traders' minds as well around the price of gold. I've been talking about this pennant formation here. This dotted line takes us up potentially to where we could well end up seeing the top just below the 2000 level. Although that being said, we are on the way down today by a small margin let me just quickly show you what's happening with the, just move that across. You can see there, not a particularly wild day's trading today. Yesterday, we were far higher than we were today at the 1962 level, but market still, broadly speaking, on the way up for gold. That said, we're back at 10:30 with Charting the Markets. I'll be back at 1:30 today with Beat the Street, taking a look at some of those stocks reporting earnings this morning, like AT&T, Philip Morris, and also UAL coming out before the bell today. All session stocks. We'll get a feel for how things are going. But today, watch out for a whole raft of those European earnings, which could well move the market. Certainly, at the moment at least, still looking for a drop across the major benchmarks here in the European session at the top of the hour.